In my 20 years as a chartered accountant working with UK businesses, I have seen the same financial mistakes destroy otherwise successful companies over and over again. Some of these mistakes cost thousands of pounds, others have bankrupted businesses, and the tragic part is that every single one of them was completely preventable. I'm Annette Ferguson, UK certified Profit First professional and chartered accountant and CEO of Annette & Co, a UK based accounting firm. And today I'm going to share with you the most dangerous financial mistakes I see business owners make, and more importantly, the secrets to avoiding them completely. These aren't minor bookkeeping errors. These are fundamental issues that can kill your business, destroy personal wealth, and ruin financial futures. But here's the good news. Once you know how to find these and protect yourself, you can avoid the traps entirely. By the end of this video, you will know the 7 most dangerous financial mistakes and how to recognize the warning signs, as well as exactly what to do to protect your business and wealth. So, if you want to avoid these disasters that destroy businesses, let's dive in. And before I share these mistakes, let me tell you why this matters so much. Every week, I see business owners who thought they were doing the right thing, only to discover they've made mistakes that cost them in the tens of thousands of pounds, and in some situations threaten their business entirely. Financial mistakes cost UK businesses millions in unnecessary taxes and penalties, thousands in missed opportunities and deductions, bankruptcy and business failure in extreme cases, personal finance ruin when businesses and personal finances are all muddled up together, and years of stress and anxiety that could have been avoided. Smart, successful business owners can make mistakes because they focus on their own expertise and not financial management. They assume common sense applies to business finances and tax law. They get advice from well-meaning but unqualified sources. They delay getting professional help until it is way too late. And ultimately, all of us, we just don't know what we don't know. The prevention principle is simple. It's always cheaper and easier to prevent financial mistakes than to fix it up and clean it up after it happens. Prevention requires knowledge, systems, and often professional guidance. Today, I'll cover the 7 deadliest financial mistakes. These are mixing business and personal finances, ignoring cash flow management, making tax decisions without professional guidance, failing to plan for business growth, neglecting proper record keeping and compliance, underestimating the true cost of employees, and making emotional financial decisions. Each mistake has destroyed businesses, but each is completely preventable when you know what to watch out for. So let's start with the most dangerous: mixing business and personal finances. This may seem harmless, but honestly can destroy a business and take down your personal wealth at the same time. This mistake happens when you use your business account for personal expenses. You pay business expenses from your personal account. You transfer money between accounts without proper documentation. You treat the business bank account like your personal piggy bank, and you don't maintain a clear separation between business and personal. The legal consequences of this can actually be devastating. Loss of limited liability protection if you're a limited company, personal liability then for business debts, HMRC investigations and penalties, difficulty proving true business expenses. Potential fraud allegations happen also in extreme cases. A limited company director regularly using their business bank account for personal expenses and their personal bank account for business costs is a real problem. When businesses like this are faced with legal suits, courts typically rule that they lose their limited liability protection because they treat their company like a personal bank account, and the directors can become then liable for all business debts. The tax implications of this include personal expenses paid by the business becoming taxable benefits, business expenses paid personally not being deductible. Becomes a difficulty in proving legitimate business deductions, and then therefore the potential for HMRC to disallow expenses completely. And that doesn't even account for additional tax and penalty charges that then get levied on the business owner. So to prevent mistakes like this, make sure that you do maintain completely separate bank accounts. Yes, mistakes happen. Sometimes we end up in IKEA with only our business card in our pocket. But really trying to be very strict with yourself on this is really important. Never using your business account for personal expenses will keep you in the clear. And then documenting transfers between accounts properly. Paying yourself a proper salary and dividends and keeping detailed records of all transactions will get you out of hot water with this. If you follow the proper process, it means your business income goes into your business bank account only, and business expenses are paid from your business bank account only. Personal expenses are paid only from your personal bank accounts, and any transfers between the accounts are documented as such. Loans, salary, dividend, whatever they happen to be. Regular reconciling ensures accuracy, because 3 months after the fact, if it gets reconciled, you might not remember exactly what's happened. So watch out for these warning signs. If you have difficulty in explaining your transactions to your accountants, that's a red flag. If you have confusion over what's personal and what's business, that's a problem. If there are irregular or unusual transfers between accounts, that can flag to HMRC. If you're using business cards for personal purchases, again, that is a red flag. And treating all the business money as your money also becomes a problem. So the second deadly mistake is ignoring cash flow management. More businesses fail from cash flow problems than from lack of profit. And yes, you can absolutely be profitable on paper and run out of cash. The cash flow trap occurs when you only focus on profit, on your profit and loss account, and you ignore cash timing. This can happen as well if you don't plan for seasonal variances in your business. You can run out of cash. If you offer payment terms without considering cash flow impact, that can be an issue. If you don't monitor your accounts receivable, the money that you are due in, and you are tracking and chasing that, that can also result in this issue. And also, if you are looking at profit and thinking it equals cash value, that can give you a problem. So here's a real life example. A successful consulting business had £80,000 of annual profit, but they actually went bankrupt because they did not manage their cash flow. They offered 60-day payment terms in order to win clients, but their own expenses were due monthly. When several large clients paid late simultaneously, they just couldn't meet their obligations, and they were ultimately forced to close despite being profitable on paper, because the cash just wasn't coming in to cover their expenses as they fell due. And that is one of the definitions of insolvency. If your business cannot pay its debts as they fall due, you are insolvent. The other is that your balance sheet, your bottom balance sheet, is negative. If both of these occur, then your business is insolvent. The thing is that poor cash flow management actually creates hidden costs as well. There's emergency borrowing that people typically do at very high interest rates, and that gets you into a borrowing debt cycle where you just have to keep borrowing to pay the business bills. but you also couldn't afford to make debt payments before borrowing. So once you've borrowed the money, you've got more payments to go out each month. So you end up borrowing more and it ends up in this spiral where you just borrow and borrow and borrow and borrow. And that is a very fast route to insolvency. Other hidden costs that poor cash management creates are missed opportunities due to lack of cash, supplier relationship damage from late payments, of course, stress and anxiety keeping you up at night, and potentially affecting decision making, and ultimately business failure, potentially despite profitability on paper. Understanding the difference. Profit is revenue minus expenses over a period of time. Cash flow is money in and out of the bank accounts. So as I said, you can be profitable but cash poor. You can also, incidentally, have positive cash flow but be unprofitable. If you go and get a loan, you've got positive cash, but that doesn't mean that you're profitable, and it doesn't mean that you're saving your business. Both matter, but cash flow ultimately determines the survival of a business. You can prevent cash flow problems by creating cash flow forecasts, monitoring your accounts receivable closely, negotiating favorable terms potentially with suppliers, managing cash reserves for emergencies, getting paid by your customers as soon as possible, and understanding what your cash conversion cycle is. Using this cash flow formula, starting cash in the month plus or week plus expected receipts minus expected payments equals your end cash position. Updating this weekly if cash is incredibly tight or monthly with actual figures is really important. Plan for different scenarios as well so you can identify potential problems before they arise. Now watch for the warning signs. If you have difficulty paying your bills on time, you're feeling the need to constantly check your bank account, you're relying on overdrafts, credit cards, or you have already got into that debt cycle that I talked about, taking out more and more loans to afford the loans and your expenses. If you're wanting to delay supplier payments a lot, that is also a warning sign. And ultimately, if you have stress and this is keeping you up at night about your income expenses and how you're going to pay the bills. The third mistake is making tax decisions without professional guidance. We typically don't make legal decisions without legal guidance, but many people make tax decisions without tax guidance, without guidance from a chartered accountant or a tax advisor. The thing is that tax rules are complex and they're not always the common sense that people think they are. And mistakes can be incredibly expensive and ultimately cost you your business. Common DIY tax mistakes that we see are having the wrong business structure, missing valuable deductions or reliefs, or the opposite, claiming things that you're actually not allowed to claim but you think you should be. Incorrect VAT decisions, whether that's registration timings, type of VAT schemes, or again, claiming things that are not claimable. Poor timing of income and expenses, a misunderstanding of things like IR35 and employment status for your team. Let me give you a real life example. A freelance consultant decided to incorporate, so move to a limited company without professional advice to save money. They chose the wrong accounting date, they missed small company exemptions, and they set up an inefficient salary dividend structure. And ultimately, their mistakes cost them somewhere in the region of about £8,000 in additional taxes in the first year alone, far more than any fees would have been. Tax complexity creates problems because rules change frequently without warning. Different rules apply to different business structures and situations. Interaction between taxes can be counterintuitive. Penalties for mistakes can be severe, and DIY software cannot ultimately replace professional judgment. I want to show you a book. This is a book that I have here, and this book here, you can see it is very big. It is written on very, very, very thin paper. And this is a guide for accountants, basically, but it's only on one type of tax. It speaks mainly about corporation tax. It goes into a tiny bit into personal tax, but this is only one small part of the tax information. And actually, the tax legislation is about 5 books that all look like this. And so thinking that a few blog posts, a few videos will give you all you need to understand the tax for your business can really cause massive issues. There are some really expensive tax mistakes that people make, like incorporating at the wrong time or in the wrong way, missing the VAT registration threshold completely, not really realizing that has something that has to be tracked every single month in your business. Incorrectly determining IR35 or whether somebody is an employee or a contractor. Poor pension planning and timing can cost businesses a huge amount of money and mean that there's an awful lot of extra tax to pay. Misunderstanding capital gains and reliefs can also be a problem. And that is why we as accountants exist, and that's why we study so much, and we have to go through all the tax legislation, and we have to keep up with the changing tax laws as well, because it means that we have current knowledge on tax rules and changes. We are able to support you with strategic planning for your specific information. We are able to be proactive with advice to minimize your overall tax liability. We are able to support with compliance so that you can avoid penalties and obviously provide peace of mind and confidence in your financial situation. It's really important that you get professional help for business structure decisions, tax planning and optimization, complex transactions or changes, compliance requirements and deadlines, or really any situation where the cost of mistakes exceeds the professional fees. Professional tax advice typically pays for itself through tax saving and optimization, avoiding penalties and interest, better business structure decisions, proactive planning opportunities, and reduced stress and time investment. Now, the 4th mistake is failing to plan for business growth. Growth without proper planning destroys a profitable business. The growth trap occurs when you accept all business without considering capacity. You hire too quickly without proper systems. You don't plan for the cash impact of growth. You assume growth will automatically increase profit. Spoiler alert, it does not. And you neglect existing clients while pursuing new ones. A marketing agency doubled their client base in a 6-month period, but they did not plan for growth. They hired staff quickly, they took on expensive office space, and they accepted clients at unsustainable rates. Despite doubling revenue, their profit margins collapsed. Cash flow became negative, i.e., the business owner was putting money in, and the business nearly went under. They had to lay off staff and lose clients to survive, and that was a massive, massive battle at a point in time when they thought they were on the high trajectory. The thing is that growth creates hidden costs, additional staff and training expenses, increased overhead and infrastructure needs, working capital requirements for larger operations, management time and complexity, and quality control and system changes. So we need to plan for growth sustainably, and we can do that by analyzing the profitability of growth opportunities, planning cash flow for the impact of expansion, building systems before scaling operations. If you try and scale before you have things in place, before you have profit, you just end up in a worse position. You need to be profitable before you scale. Hiring strategically rather than reactively, and maintaining quality standards during growth. You can use this growth framework instead. Assessing the current capacity and restraints, identifying profitable growth opportunities, planning resource requirements and timing in relation to those, implementing your system so that you can support the growth, and making sure that you monitor the performance and adjust your plans as necessary. Financial planning for growth includes cash flow forecasting with scenario analysis. You shouldn't be planning for growth at all if you don't have a cash flow forecast in place, because you will run out of cash if you've not got your eye on this. Making sure you do profit margin analysis for any new business that you're taking on. Looking at your working capital requirements. So that's the cash that you need in order to fund this, and potentially funding options if that is applicable to you. And making sure you do a risk assessment and contingency planning. All of these things I know sound boring when it comes to looking at your sales system or your marketing plan, but these are the foundations for growing and scaling your business. And without them, things fall over and businesses run out of cash. So watch for these warning signs as well. Declining profit margins despite growth, cash flow problems during busy periods, quality issues or client complaints, staff stress and burnout, and ultimately the inability to deliver on promises. Now, the fifth mistake is neglecting proper record keeping and compliance. Poor records cost businesses thousands of pounds in missed deductions and in penalties. It is a legal requirement that UK businesses keep up-to-date and accurate books and records for all transactions, including supporting documentation, VAT records if you are VAT registered, employment records for staff. So this is all a legal requirement, up-to-date and accurate, okay? Common failures with this include lost or missed receipts and expenses, inadequate documentation for business purposes for things like travel expenses that are claimed. If you're claiming mileage, you need documentation for the mileage. Poor organization generally of financial records, failure to back up any digital records if you have them, inconsistent or incomplete record keeping. We see this all the time from clients who choose to do their own bookkeeping. They just don't keep up to date with it because, of course, more exciting and fun things come along in your business. So we completely understand, but the issue is that it is a legal requirement to keep up to date and accurate books and records. So a consultancy business faced an HMRC investigation and they couldn't provide adequate records for around £15,000 of claimed costs. Without the proper documentation, HMRC disallowed the deductions and imposed penalties on the business. The total cost was £8,000 in additional tax and £3,000 in penalties, all because of poor record keeping. There's actually been a VAT case recently that's gone through the courts as well, where HMRC have said that because the VAT documentation was not basically tagged to the transactions at the point in time that the VAT return was submitted, they are going to disallow the claims for VAT, meaning that this individual's or this company's VAT bill has shot up, and they also have interest and penalties on that. So this is not something to mess around with. Poor compliance results in disallowed expenses and deductions, HMRC investigations and audits, penalties and interest charges, potentially professional reputational damage, and increased scrutiny in your business from HMRC for years to come. Implementing digital record keeping is a must nowadays. Using cloud-based software, we recommend Xero, but you can also use something like QuickBooks. Making sure that you photograph receipts immediately and organize your digital files systematically. Potentially having backups as necessary for that. And that helps you maintain an audit trail for all transactions. Make sure that you're maintaining documents where they have the date, the amount, and the business purpose visible. Receipts and invoices for all transactions is the gold standard. And you should also be making sure that you have your bank statements, that you're downloading those on a monthly basis, and the full reconciliations are being done. That doesn't mean just hitting OK and matching transactions in your bookkeeping software. It means actually doing the reconciliations, making sure you have contracts and agreements in place, and making sure your employment and payroll records are kept up to date and submitted on time. You can create prevention systems with this by regular bookkeeping and reconciliation, either done in-house in your business or giving that to your accountant to do. They will typically have a bookkeeping service that you can utilize for this. Make sure you have systematic filing and organize your receipts. Have backups as necessary and security procedures in place. You also want to be doing regular reviews of your record keeping to make sure that you are staying compliant and getting professional compliance support as well. Now, the sixth mistake is underestimating the true cost of an employee. Many business owners only consider the gross salary and don't actually consider the full total employment cost when you're taking on an employee. Hidden employment costs include employers' national insurance contributions, pension contributions and auto-enrollment, holiday pay, sick pay, training and development costs, recruitment and onboarding equipment, additional software costs, and workspace costs if you have a physical business. You want to calculate the true cost by looking, first of all, at the base salary and then adding on the employer's national insurance and pension contributions. You also need to look at holiday entitlement and overhead allocation. You want to add on at least 15% to the base salary, but in many cases it can be more than that. So look at the true cost for your business. Underestimating these costs affects your cash flow planning and budgeting, pricing decisions and profit margins, growth planning and hiring decisions, business viability and sustainability, and the accuracy of your financial forecasts as well. Remember that you're also going to have additional management time and supervision. You're going to have a productivity ramp up period when you take on a new employee. Unfortunately, we can't just chuck them stuff and they know what to do. We need training, and mistakes can happen, particularly in the beginning. You need to also make sure that you're complying with employment law. There's HR costs. You need employer's liability insurance. If you are employing somebody, that's a legal requirement. So making sure that you calculate the total employment cost accurately, you ensure that revenue can justify the investment. You plan for a productivity ramp up, and there may be actually alternatives to permanent employment that might actually work better for your business. So it's important to consider those too. Budget for all the associated costs, and this can help avoid this mistake. And mistake number 7, the final mistake, is making emotional financial decisions. Emotions and money typically don't mix wonderfully in a business. Common emotional decisions include panic spending during cash flow problems, revenge spending after losing a client, ego-driven purchases for status, fear-based decisions that limit growth, guilt-driven overpayment to staff or suppliers, and fear-based debt. A business owner that we know lost a major client in a panic. They spent £20,000 on marketing and advertising to get more clients, but without a really clear strategy. And this emotional decision wasted money that could have sustained the business during the transition. A strategic approach would have been to reduce costs, focus on existing clients, and develop a targeted business development plan instead. Common emotional triggers that we can see are fear of losing a client or revenue, anger over competitors or market conditions, guilt about business success or failure, pride and ego affecting judgment, and stress and anxiety clouding decision making. The cost of emotional decisions is money spent on unnecessary purchases. Opportunities also can be missed due to fear. Relationships can be damaged due to poor judgment, time wasted on inefficient strategies, and long-term damage to the overall business health. What we actually want to do when we are making decisions is identify the real problem or opportunity, gather relevant data and information, consider multiple options and alternatives, evaluate costs and risks as well as the benefits, and make decisions based on facts and not purely on feelings. We need to take time before we make major financial decisions. It can be a good idea to consult with advisors or mentors or your accountant, and using the data to analyze and guide your choices. Using a professional advisor or your accountant for this helps you get a objective perspective on decisions. It helps you look at the data-driven analysis and recommendations. They can often be experienced with similar situations as well, and it helps you emotionally distance from the problem. Now, let me show you how to create a comprehensive system that protects you from all 7 of these dangerous financial mistakes. The prevention framework. Build your prevention framework. Have clear policies and procedures for financial management, regular monitoring and review systems, professional support and guidance, education and awareness for you and your team, and contingency planning for professional problems. Monthly health check. Conduct monthly financial health checks. Review your bank account separation and transactions. Analyze your cash flow position and forecasts. Assess compliance with record-keeping requirements. Evaluate recent financial decisions for emotional bias. And plan for upcoming challenges and opportunities. And your professional support team. Building out your professional support team is really important as you grow your business. Using a qualified accountant for tax and compliance. Now, you might note that I've said qualified or chartered a lot here. I want to take a side note to say that anyone can call themselves an accountant. They don't need a qualification. So making sure the person you choose is actually qualified is really important. The highest level accountant is a chartered accountant, and they can be chartered from the Institute of Scotland, the Institute of England and Wales, are both the chartered institutes in the UK that accountants and chartered accountants qualify under. You will see that written as ICAS, Institute of Chartered Accountants, or ICAEW, Institute of Chartered Accountants of England and Wales. Both are basically the same and both can act with businesses throughout the UK. You might want to look at a business advisor for strategic decisions, although many accountants will offer this service as well. A bookkeeper for your day-to-day record keeping. Again, though many accounting firms can also offer this as part of their service. But you may also want a legal advisor for contracts and structures, and a financial advisor, an IFA, an independent financial advisor for personal wealth planning is typically important as part of your support team as well. You can create early warning signs in your business too, and that is looking at cash flow monitoring and alerts, regular financial reporting and analysis, compliance calendars and reminders, decision-making checklists and criteria, and regular professional reviews and advice. Consider the cost benefit here. Prevention costs are manageable and predictable. Mistake costs are neither of those things, and they can be potentially devastating. Professional fees are a tax-deductible business expense. Penalties and interest are not. Peace of mind and confidence is invaluable, and prevention always costs less than the correction. Make sure you prioritize implementation. Address the mistakes that pose a great risk to your business. Implement systems in the area where you are the most vulnerable, and get professional help for complex or high-risk decisions. Review and update these systems regularly. So let's recap the 7 deadly financial mistakes and how to avoid them. Mixing personal with business finances, maintain strict separation. Ignoring cash management, implement forecasting and monitoring. Making tax deductions without guidance, get professional advice. Failing to plan for growth, create sustainable expansion strategies, neglecting record keeping, implement proper systems with compliance, underestimating employee costs, calculate true employment expenses, and making emotional decisions. Use a rationale framework with professional support. So here's my promise. If you implement these prevention strategies for the 7 mistakes, you will save thousands of pounds and avoid financial disasters that can destroy businesses. Take these immediate steps this week. Audit your current practices against these 7 mistakes. This month, you can implement prevention systems for your highest risk areas. This quarter, you can build a professional support team and systems. And this year, you can have comprehensive financial management and protection systems in place. If you want a professional assessment on your financial mistakes and a customized prevention plan, then we can support you to do exactly that here at Annette & Co. We help UK businesses do exactly the prevention strategies that we have talked about today. You can book a call with me to discuss that further and how we might be able to support your business. The link will be in the description for this as well. Now, if you've enjoyed this video, I would love if you want to subscribe to the channel. Please make sure you turn on the bell so you know next time a video is uploaded. And I would love if you want to join me inside my Facebook community, Profit First UK Online as well. The link is also in the description for that too. Remember, every one of these mistakes is ultimately preventable, but only if you know what to look out for and you take action to prevent yourself. Don't wait until you've made these expensive mistakes to implement systems, because it will cost you so much more. The cost of prevention is always less than the cost of correction. It's time to protect your business now before the problems occur. Don't let preventable financial mistakes destroy the business you've worked so hard to build. Thank you so much for tuning in today. I know your time is incredibly precious, and I really do appreciate you spending some of that with me. I will speak to you all very soon. Take care.